Welcome back, investors, to Ticker Time News. I'm Adam, and markets got off to a decent start to kick off this new week, despite gapping down over the weekend with commentary out of the Fed meant to deflate investor enthusiasm, literally kick investors in the back and knock them down to try to get the wind knocked out of them. After last week's, of course, bullish CPI print. As we talked about before, this may become a common theme. The Fed will not be happy with a wild speculative rally in the market. The Fed will want to keep that rally maintained, keep it under control. Don't let it get too high. Don't let it go too far. That's what the Fed's going to do. It acts to moderate the tightening in the system and foster greater inflation risk. So any rally is, in a sense, bucking the Fed, going the opposite of what the Fed wants. That's okay, because right now, the Fed is not our friend. And of course, that's going to remain true until inflation is completely under control. At 7.7%, there's still a long ways to go. And that message is likely to be the mantra in Fed speak over the coming days, which will be a headwind to risk assets and harbinger of range-bound action for the market. So I do not expect this rally to continue. To answer the question in the title of this rally, in the title of this video, can the rally continue? No. The Fed won't let it. The Fed will do everything it can to scare the market into thinking, watch out. Don't let this rally get ahead of you. Now, I've got a couple quotes that I want to mention here in just a moment about what the Fed said today. But just remember, this week, it's littered with Fed speak. So you will get a ton of news titles, headlines that will rule this market. We're going to look at the charts here deeper anyway, too. I want to show some key points here. Also, update what the weekly expected moves are for the main indices. But today saw another try to break above the key 4,000 level in the SPX. On the screen, this is the daily chart for the SPX, the S&P 500. Another 75 basis point rate hike? I don't know. I don't know if we're going to go that high. 25 is too low. 50, I think, hits the mark. I think it really depends on what the next month's read is on inflation. If another chunk of the CPI inflation number comes down, then I think we have a good likelihood of a 50 basis point. If we just got a reprieve for a month and it kicks back up again in the next month's reading, that could have potential for a 75. But I think another 75 would definitely shake the market. We've gone too far. The market this rally has gone too far for the Fed's liking. The Fed doesn't like it. But the Fed can rock this market with Fed speak. When the Fed officials go out and they give their their speeches to different associations throughout the week, that can be enough to shake the market without having to do another big rate hike. So we'll see where that comes in at as we get closer to it. Is it December 21st? Or am I thinking of September? Give me a quick second. Just gotta look at my notes. I always have notes written down. FOMC, December 14th will be the date. Right there. December 14th. I always have it written down. My shopping list is written down here too. And of course, my notes for today are also written down here. Okay. The 4,000 level on the chart. Let me get the highlighter here right quick. there's a, you can see the 4,000 number there on the chart. There's a red trend line right here. This is acting as pretty stiff resistance for the S&P 500, okay? We had mostly a narrow trading range today that attempted to break above that 4,000 mark, but it did not. It couldn't get above the 4,000. As a matter of fact, it got to 4,008, and that was it. Now, if you look, the Fibonacci retracement, it starts up here, okay, at the summer high, and it goes down here to the mid-October low, or you could say the mid-August high to the mid-October low. 50% retracement. We went through that point last Thursday. It was right here. And then we marched up to 4,000. Well, 4,008, the top of the wick for today's candle, 4,008, that's another Fibonacci retracement level. It's the 61.8%. So 4,008, it's not just going to be sticky because it's 4,000, and this has been a problem in the past. We can go back there, we can go back here. You know, we can find other problems in the past or other activity, okay, where the 4,000 level became a sticky point for the market. It either acted as resistance or acted as support. Right now, it's acting as stiff resistance for the market. And I think that's going to continue because the Fed, from what we saw over the weekend, the Fed's not going to want this rally to keep running. The Fed's going to want this rally to cool its jets and to pull back. And a couple things that I have written down here specifically about this chart, besides the 4,000 level is going to be sticky, we have the 61.8% Fibonacci level. It's at 4,008. So again, right there. We also have the 5-day EMA, and that 5-day EMA has been coming up like this, and it stops right there. And I know it's tough to see, but today's red candle, it ended, and it did not reconnect with that 5-day EMA. So I suspect that we could have red again tomorrow, and we could have red until we reconnect with the 5-day EMA. And just to give you perspective, the 5-day EMA is at right now 39.13. Okay, 39.13 is the 5-day EMA, and the market, I believe, will stay red. Just trying to do some updates here and delete some things. That 5-day EMA is going to want to reconnect with the candles. We don't stay disconnected for very long from these points, right? And Thursday, even though Thursday started the day connected with the 5-day EMA and then took off. Last Friday, well, we had follow through, which pushed us even further away from the 5-day EMA. So 39.13, that's where the 5-day EMA is right now, and we closed at 39.57. So we're still a bit a ways from that. So we've got to reconnect with that at some point. And until we do, I don't really see red days or us pushing above the 4,000 level until we reconnect with that moving average. Okay, going back, and you can look at all the candles throughout history here. Typically 2 days max, okay, that you stay disconnected from the 5-day EMA. It's the most frequently tagged moving average out of all of them. Of course it is. It's only a 5-day one. But a real big disconnection that I can see on the chart here is right here. Okay? We stayed disconnected 1, to 3 days before reconnecting. Okay, so it's a very important EMA to tag, and I'm just going back through here just to look real quick. That 3-day gap right there, that's the biggest gap that I can see right now of staying disconnected. Everything else, max of 2 days. So here it is, day 2, and we're still disconnected from it. That doesn't look good for tomorrow. The Fibonacci retracement, 61.8. We talked about that. It's just above the 4,000 level at 4,008. That's a resistance zone. And then we don't talk about it too much, but gaps get filled. Last Wednesday to Thursday, there is this gap right here, this yellow box. That's a big gap hanging out there to get filled, right? So remember that, it left a huge gap. It is possible. It is possible. I see, I don't want to skip your question here, but I see this. It kind of goes into context of what I'm saying. I wonder if PPI show softer number or show soft number like CPI, it may run again. That's true. But what if it doesn't? Then what we could end up having is we could have a big drop down and then a gap down, filling that gap, and that would be an island topping pattern. The last time we had an island topping pattern was up here at the top of the summer rally. We had this gap up, right? And then it ran up for about 4 or 5 days, hit the top, and then ran down, and then it gapped down on the way down, creating this island gap topping pattern right there. It's not out of the woods yet that we're safe from something like that occurring. PPI report is going to play into that, and so is Fed speak this week, okay? PPI comes out tomorrow. I'll talk about that in just a moment. It's important to understand for context about tomorrow. Okay, so that's all of my notes here for the SPX and what I see. Now, the 200-day moving average is currently sitting right around 40.80. The 41.15 mark on the SPX, call that a zone between 41.15 and where the 20-day moving average is at 40.80. And that would be, I think, the absolute top, right? If PPI comes out and it's excellent news and we do happen to move aggressively with a ton of momentum, increased volume to break that 4,000 to 4,008 zone, I think that 40.80 to 41.15 area would be the absolute max this would go. I don't see it going higher than that in the short term, okay? I think there's just too many headwinds right now playing against the market to get up much higher than that. And then, of course, the what if PPI comes in and it hasn't showed any slowdown yet. Let me just, since I'm going through the comments here, I did not trade today after seeing the expectations barely move the market. Yep, good call there. When we have, and I'll go here on the 5-minute chart, it's going to look a little messy because I've got a lot of lines on my chart right now, trying to track what could potentially move this thing and where are the zones that we need to be watching. So when I bring this down so we can see it, I open it up some. I'll open it up so it's just mainly today on the chart. I mean, look at this. We had a low set, a gap down this morning, and then we had a low set right here early this morning, and then that kind of held all the way until the close, and then we got a character change in the market where it broke through that low of the day, creating the absolute low for the day into the close. And then earlier today, mid-afternoon, when we got to the highs of today, we just couldn't go any more than that Fibonacci retracement level, 61.8% at 4,008. So we've got some headwinds here to deal with. And that 5-day EMA being so disconnected from it, that's a big one, okay? Now, in the last hour of the day, the market kind of like falling off a cliff like that, there was some news right at the end of the day that the rail unions, they didn't rectify their labor agreement, putting a possible strike, or at least the potential of a possible strike, back on the table. Plus, the failure to maintain a position above that 4,000 mark on the SPX was a disappointment in and of itself. So, headwinds again. Now, it was notable, I should say, that this slide in equities was not accompanied by any responding push higher in interest rates, the 10-year and the 2-year, and even the dollar. They stayed under control. They didn't push higher this afternoon when the markets pushed lower. I found that disconnect to be very interesting. I don't think it's a disconnect that's going to stay for very long. All right, let me open this chart back up here, and I'm going to go to the SPY, and I want to show you the Dow real quick with the ticker DIA. It's interesting. All right, let's go to the SPY. Very similar setup here as to the SPX. Let's load up all of our lines load. Oh, I forgot to tell you the weekly expected move. I'll hop back over there after we finish the SPY to tell you what those are. Okay, so here we go. First off, the weekly expected move for the SPY, 408. And isn't that interesting? 408 is the upper end of the weekly expected move, and 388 is the lower end of the weekly expected move for the SPY. And there are a couple of interesting pivot points at 388 for that to be the lower end of the weekly expected move. When we gapped up last Wednesday to Thursday, we gapped up to 388. Very interesting, right? In this rally we've been in since the middle of October, 388 was like a resistance point that sent us lower going into the last FOMC meeting. And then prior to that, it was support, and then it acted as resistance right before, again, that last FOMC meeting in September. So both FOMC meetings, September and October, 388 was bam. It was it. We couldn't go any more than that. So now we're here looking at the SPY. 400 is like the shield. It's stopping it. That's resistance right now. And that perfectly lines up with the Fibonacci retracement level, 61.8%. That's at 399.99. So call it 400 from that point. So 400 is clear resistance. We are big time disconnected from the 5-day EMA. All right. So we're kind of going through the same check marks that as we did with the SPX. So that 5-day EMA right now is sitting at 390. 390. We closed at 395. We are $5 away from that 5-day EMA, and we need to reconnect with it. Just like with the SPX, 2 days is typically max that you stay disconnected from that 5-day EMA. Remember, think of it like a circuit board. All the little wires have to be intact. The circuit has to be closed. Or, I'm sorry, the circuit's got to be open so electricity can flow all the way through it. When you get a disconnect from that circuit, when it's closed, then that electricity, it can't make its way all the way around. It stops. Think of the candles in the 5-day EMA just like that, okay? Or even simpler, a light switch. When its light switch is off, you get no electricity, then the candle's got to either fall back down or glide back up, whatever the case, to reconnect, and then the switch can be turned on. Okay, it like loses that energy. It can't go any further. All right, so we've got all of that lining up here. Good question here. Let it load up on the screen here so we can all see. Where would you buy puts? Okay, right now, this is the time that you would want to start opening and going short on the market. Whether you want to use the options market and buy puts for the SPY or Qs or whatever the case may be, or you want to use specific ETNs and even the options market in a combination to short the market, now's the time to start slowly opening those up. Don't rush in. Big position sizes. Keep the position sizing small. 1%, 2%, max 5% of your portfolio. You can always adjust that as things change. But small position sizing has been a godsend all year long because of volatility. You never know when it's going to flip, okay? So now's the time to start loading up on your shorts, but be careful doing that. Retail investors have got a lot of outstanding puts that can create a short squeeze potential. All right, so with this stiff resistance here, needing to reconnect with the 5-day EMA and then having this gap down, right? This gap down that, or I'm sorry, gap up that was created, a gap period that was created last week, that would bring us all the way back down to 380 on the SPY, okay? 380 on the SPY. So that would probably be as low as I'd go, 380, and then give it some time to reach that point. Now, with the PPI tomorrow morning, you don't want to start shorting or going long or doing anything until that report comes out, and it comes out before the market opens, so you can understand how the market's going to react to that news, okay? It could be a thing where it's good news and the market wants to rally, but it can't get enough momentum behind moving above 400, okay? It's always a possibility. Think about the major head twist that we had in the major pivot October 13th, CPI day. The market opened down big, and we had a huge rally that day. It was just incredible, and it was not logical, okay? That's something that we have to watch out here too. Even though I am pointing out to you with the evidence on the chart of these very specific points, sometimes investors can let their feelings take over and they can chase something that they shouldn't or what have you. And the market can act irrational. Right now, I'm telling you, at 400, there is stiff resistance right now. I'm telling you, it's disconnected from its 5-day EMA. Usually 2 days, 3 days max, it stays disconnected. It's got to connect. We're also at the 61.8% Fibonacci retracement level, right at 400. We have a major gap that was created last Wednesday going into Thursday. Gaps get filled. 380 would bring us back down to the bottom of that gap. So these are the important numbers to know. 400, it's like resistance. If we do somehow break the 400, the max that I think we would ever go is 410, 408 to 410. That would be like the max that this rally could push us. 400 is resistance. It's also the 61.8% Fibonacci retracement level. And then we have the top of the gap that was created last week. Also, the bottom of the weekly expected move, 388. And there's a lot of reactions on that 388 number. It can be sticky, okay? And then the bottom of that gap is at 380. So those are your numbers and why. And I want to add one more thing back to the very top number, the 408 to 410. 408 is the upper end of the weekly expected move. Okay? So those are the important numbers to remember and why for the SPY. All right. Got that. Okay. There's a lot of stocks disconnected from their 5-day EMA. Yes, that is true. The market's been on fire on Thursday, especially, and then a follow-through day on Friday, which has a lot of stuff right now leaning towards not quite overbought because we had to pull back a bit today, but things are starting to get a little hot there because of how quickly it's the rate of change, how quickly we went from, all the way down here at a support number, going from down here. Where did my highlighter go? There we go. Going from down here all the way up to right here. Actually, I should take that out. Hold on. All the way up to here, a little bit higher. That gap right there in a single 2 sessions. From a close of one session to the close in 24 hours. The close of one session to the close of another session gave us this humongous, gigantic move. Okay? And unfortunately, it's tough to follow through with gigantic moves like that. All right. So as the indices are coming down, of course, all of the components that make up those indices, all the stocks that are in those indices, they'll have to come down too. Where will we be wrong? Wrong as too many puts? I need a little more context with that question, if you wouldn't mind, please. I know it's probably going with your other question of where would you buy puts? Now is the time to load slowly on puts, small position sizing. I'm sure your question, where will we be wrong, links into that, but I need a little more context with that question. My apologies, Rebecca. All right, let me then keep moving. I want to look at the Qs next and give you all the numbers on the Qs, and I'll go back to the SPX for the weekly expected move. All right, let it all load up here for the cues. If you're looking for a stop loss, it would be if you were to go in at 400 looking for a stop loss, if you went in around the 400 level, 395 now, since we closed. Let me go back to the SPY here real quick, and then I'll come back to the cues. So if you were to enter, and again, not financial advice by any means, just a hypothetical of what I would do. With the lines load back up. We closed at 385 today. So let's just say that you entered, at 395. If I didn't say that, 395. Just waiting for my lines to load back up. If you entered in at 395 on the SPY right here, and you're shorting the SPY, I would look for 388 first to take profit, okay? And then I would look for 380 to take the remainder off the table, because if we went that far down in a single week, then we'd probably pause unless some awful news came back out. And if you were opening up that at 395, I'd probably set the stop loss maybe 402, 403 to give myself a little bit of wiggle room in case it does break above that 400 for just a moment and then comes back down, because you never know how it's going to play out before it finally drops. So that's kind of what I would think there. Entering at 395, stop loss at 402, take profit at 388, take profit at 380. That's how it would line up for me. And then when would we be wrong with buying puts? Well, if we go down here and we start retesting, okay, the low for the year on the SPY in between these two highlighted areas, we're looking at 348 as now. Let me just say this one more thing. Let me back up a second. Once we get to this area right here, which is right about the 374, 375-ish, that area is probably going to act as support, okay? And then I would probably start looking, well, could we get a little bounce from this? Because over the next several weeks, it's possible that all we're doing is, there we go, that all we end up doing, now why is my chart acting up like this? Okay, that all we end up doing is just moving sideways between these 2 points. It's a very big possibility that's what we do in the month of November. Because if we go back, and I haven't pulled this up in a moment, when you go back and look at the seasonality chart, midterm election year, okay, what happens in November? November moves sideways to slightly down. That's what November does on average. So you have to keep that in the back of your mind, that during the month of November, during a midterm election year that we are currently still in, going back to 1946, What are we going to do in November? Move sideways to slightly down. That's what November is going to look like. That makes it hard to trade, easy to trade, depending on your skill level. Because if we're just bouncing up and down, then it makes it easy to short, go long, short, go long, short, go long. You know what I mean? But then back to that seasonality chart, once we get into December, then we could potentially see a nice Santa Claus run or Santa Claus rally. Okay? So keep that in the back of your mind, what historically markets do. Okay? Because that chart has played out so perfectly for 2022. It really has been incredible. Okay? It's caught all the major lows this year. All right, going back to, I hadn't finished on the cues just yet. You are welcome. All right, let's get the cues lined up here on the chart. Talk about these key points. Now, we have a bit of a shooting star type candle on the cues, which isn't bullish. That's not typically a bullish signal at all. As a matter of fact, if we go here, let's pull this up right here. Another chart that I'm going to start showing more frequently so you guys can get the hang of this. We got the shooting star. Where's my drawing tools? There they are. Okay. All right. So this right here is the shooting star type candle. Typically you have a rally leading up to this candle, and then notice the actual candle in the middle. Okay, the candle in the middle, it has a larger wick on top and a small body underneath. All right, that's important to know about the shooting star candle. Okay, and it can be seen as bearish. Now, we've got our rally leading up to this candle, and the candle's really small because it's got that small body on the bottom and a large wick on top. This could be seen as a topping pattern. So play that very carefully. See the last two green candles, and of course the big gap up from the third candle off of today's candle. And then we've got the big wick on top, small body on the bottom. And let me just pull that chart back up again. So here it's three. Oops. I don't want to move it. I want to draw on it. So here we have our three. Oh, come on. There we go. The three candles rallying to the shooting star type candle. Now, I know the candle is not above yesterday or Friday's candle. The wick is, so we've got that to look forward to as a possibility. You can go SQQQ, absolutely, to go short on the Qs. All right, let me talk about the key points here real quick for the Qs so you have them. I'm just going to open this up a little bit more to focus on the recent candles and the levels. All right. Need to bring it up a little bit. Bear with me. Okay. Let's see if we can do it right here. I know it lags. It stinks. Okay, so for the Qs right here, all right? Right now, it's hanging on not to its 50% retracement level, only hanging on to its Fibonacci of 38.2%. There's a Fibonacci level here, and it seemed to act as support today, which is interesting. I don't think this is going to turn out to be support because at this exact level, okay? And this is, what would this be? This would be, we're closing right on it, 285. 285 was resistance. 285 was resistance. And then we blew past it on Friday. Now 285, it kind of acted as support here, or maybe it was just a comfortable level that people stepped in thinking, oh, well, you know what, maybe this is an okay level to step in and buy at because it was old resistance, keeping it from dipping further below. All right. And of course, it is a Fibonacci level too, so maybe that has something to do with it as well. But old resistance becoming new support, it's a possibility. The Qs are not as far along in the progression as the SPY or the SPX is. All right. The SPY and SPX, they're above their 50% retracement level. The Qs are not. The 50% retracement level for the Qs is 294. 294. That's the 50% retracement level for the Qs. And that'll be a very sticky number. Now, the weekly expected moves for the Qs. On the top end, we have 297. 297. And remember, that 50% retracement is at 294. So 3 points underneath the upper end of the weekly expected move. The lower end of the weekly expected move is 278. 278. That's a very sticky number. Okay? It's been resistance, it's been support, it's a very sticky number. Now, also on the Qs, one thing that is similar is the gap that was left from last Wednesday to last Thursday. It's a gap going from here to here. So that's a pretty big gap. That gap starts right around 276. Okay? So if we break down from this point, and again, tomorrow's PPI data, that could give us some momentum to move up, even though we are at these resistance points for the SPX and for the SPY. The Q, however, the Q could bounce from this level and start heading towards the 50% retracement level. Okay, that's possible. Technology got beaten down. Look what happened to Tesla and Amazon today. They were down over 2%, both of them. So, technology is just getting hammered. So, I would be more cautious on the Qs than I would on the SPY or the SPX. Okay? So, you got the weekly expected moves, you got the Fibonacci numbers, you have the gap that was left from last week. And that gap, there's a lot of support inside of that gap, okay? There are anchored VWAPs that are in there, anchored from the summer high, anchored from September's FOMC meeting, anchored from October's FOMC meeting, anchored from the low of 2022, which was the 13th of October. All of these VWAPs are, or VWAPs, they're all meeting right here in the gap that was left yesterday. I'm sorry, that was left last Wednesday to Thursday. Now, they all kind of meet around the 271, 272 area. So that would probably be an interesting support area. Plus, I know it's in the gap, but 271 is a resistance. I'm sorry, a support. A support. Okay. Going back here, 271 was support right back there. All right. It also acted as support on that red day and resistance the next day. It was support for these 2 days. All right. So that 271, it is a support area. So keep that in mind. All right. So those are the points to watch for the Q. The Q, just be more cautious on, since it is in a little bit of a different setup and structure. Well, structure is kind of the same. Just didn't move as fast, and it was further down. Because the Qs, don't forget, this is something the Qs did that the SPY SPX didn't. Right here on November the 3rd, the Q set a new 2022 bear market low. None of the other major indices did that. They weren't even close to doing that. So the Qs have definitely been on their back foot for a while now. All right, let me go to the SPX real quick just to give you those weekly expected moves. And then I'm going to go to the DIA. I do think there's something interesting there to show you about the Dow Jones. I think it could be at resistance. It's been performing really, really well. But again, this talk, it can be taken out of context when we have a data dump tomorrow. Okay, so just take what I'm saying, use it for your own thesis on the market, combine it with the data drop tomorrow morning, the PPI, and then go after it. Okay. All right. So the weekly expected move for the SPX, S&P 500, on the top end, it is 4091, 4091. On the lower end of the weekly expected move, it is 3894. 3894. All right, let me go back to the DIA. All right, let's get this up here. Hey, Adam, tuning in late. No worries. Tune in whenever you have a chance. I just wanted to say thank you for your analysis yesterday, on Friday or yesterday. Saw the multiple resistance points on IWM and opened a put today. I'm up 18% already. That's awesome. Hot dog. Hats off to you, sir. That is wonderful. I am very, very proud and happy to hear that. Absolutely. It leaves me speechless, actually. I don't know what to say, but thank you. I greatly appreciate that. I hope these points can help anyone and everyone out there. So I greatly appreciate that comment. Thank you for saying it. And let's go and talk about real quick the DIA, which is the ticker to trade the Dow Jones. And then we'll go talk about the IWM next. Okay, Dow Jones, obviously, been outperforming the bunch, doing really well. However, yeah, Friday. Yep, I took it as Friday. Absolutely, no worries. No worries. We have a interesting candle pattern here. I think it leans more neutral than anything else, but yeah, there's a specific candle pattern there. I'll show you. I need to bring this chart down just a little bit here, squeeze it up a little bit, because the Dow is getting into a very interesting situation here. Okay. As you know, the Dow has been on a strong rally since hitting its low on October 13th, right? Big, strong rally. Here's some key numbers. Number one, the weekly expected move for the DIA is 345. The lower end of the weekly expected move for the DIA is 330. It's sitting right there, slightly in the middle, a little bit to the downside of middle. Now, what's very interesting, it's running into very, very stiff resistance. If there was ever a time to consider shorting the Dow, now might be that time. The reason I say that is if we go back and look, the summer rally, the mid-August high was right here. Where's the Dow? The Dow is currently right here. It is just under breaking through, and this is a big if, but if the Dow broke this level and went higher, it is possible that it could break that summer rally. And if it did, it would have set a higher high from the middle of August. All year, when we've had these high peaks, we've made lower highs all year. Let me reduce this chart back down so you can see all year. Okay? I want to get all of 2022 in here, and there we have it. So if you notice, we start, okay, we have a high right here. The next major high is here. It is a lower high. The next major high is the top of the summer rally. That is a lower high. So if the Dow wants to break from this point, it would be making, if it ran up to the weekly expected move, it would be making a higher high. And that's what you'd want to see if you're bullish on the market. However, I don't think there's a lot of things to be bullish about the market just yet. 2023 is going to suck, especially the first half. Okay? There's no way this rally is going to continue much longer. So, again, if there was ever a time to short the Dow, ticker symbol DIA would be a way to do it. All right, let me go back in now and open it back up here and show you a couple of other key points. So just to have the number that it would need to break, that number is 343.7. 340, am I seeing that right? Yeah, 343.7 looks to be the number that it would need to break in order to, well, hold up here. I may have, did I read that wrong? 343. Yeah, $343 is the Dow. If it broke that number, it would be making a higher high. And in technical analysis, that is always super important. All right? If you're making lower lows and lower highs, you're in a downtrend. If you're making higher highs and higher lows, you're in an uptrend. So very interesting here. But now is definitely a place that I would heavily consider shorting the Dow. All right. So we got that number. We got the weekly expected move. All right. On the lower end of the weekly expected move, just above it, we have the 78.6% Fibonacci retracement level. So that could act as support or be a sticky area. The weekly expected move on the lower end is actually a place that's been resistance in the past right there. It's also been support right back here. So that's a sticky number. It's a sticky place. It may actually hold this week for the weekly expected move. And then below that, the next area would probably be the 61.8 retracement level at 321 to 320. Okay. All right. Let's go to the IWM. And then I've got a couple more thoughts here about the market that I want to talk about. And then we've talked about everything then. All right, let this load with the moving averages load up as well. Okay. All right. There we go. Now we got everything we need. Okay, now the IWM, it is at a very weird spot, okay? Because it has run all the way up to its resistance, and I mean severe resistance. There has been a trend line for all of 2022, and it's this blue line coming down here, all right? It got the summer rally, mid-August high, and that trend line comes down just like this, and guess what it just captured? It captured the Friday high into today. So, like the Dow, now may be a great time to short the IWM. But I would put, I would say one thing though, okay? With where it's at, here's where the weekly expected moves are. Now, this doesn't mean the market has to go to the top one or has to go to the bottom one, but it has a 68% win rate, okay? The weekly expected move for the IWM on the top side is 192. I don't think we're touching it. But PPI tomorrow, that makes it tricky to say that and mean it 100%, or to say that with 100% confidence. All right, the lower end of the weekly expected move is at 181. All right, 181. I think we have a greater chance of reaching that than the upper end, mainly because of this resistance line, all right, that's coming down here. Plus, we have the 200-day moving average, which is coming down like this, all right, that also meets there. And then third, yeah, this is a trifecta of resistance. We have this line going across here, all right? This is the 61.8% Fibonacci retracement level. So we've got three very important lines on the chart, all crossing over together, right? Creating resistance for the IWM. Meaning it's going to take a lot of momentum, a lot of volume if you want it to go above that point, okay? I don't think it's going to. PPI data tomorrow, it could cause us to gap up in the morning. If it shows inflation came down, it could gap up in the morning, and then it could sell off the rest of the day. That's a possibility, all right? So that's the IWM right there. I think it's at resistance. Now, coming down, we do have a gap, all right, that was left. It goes from here, and it starts at about 181, and it goes all the way down to 177, which is a very important line, okay? Very important. Now, that line here is also at the 38.2% retracement on the Fibonacci. So we've got a fib line there. We also have a support and resistance. See, it was support back here as well. It was also support right there before resistance one day, resistance right there. So it's a very sticky number, 177, okay? So keep that number as a potential area. If you are shorting from here at where'd we close today? 184. Make sure you're taking profits. Number one, when you get to about 280, take a little profit, and then you know, take even more or close it out completely at 177. Okay. Very important numbers here for the IWM. All right, just trying to clean the chart up a little bit. All right, let's see here. Is that inverted hammer on the Dow? Okay, let's go over there real quick. Ticker symbol DIA for the Dow. I talk about so much I don't even remember. Oh yeah, I mentioned these candles here. Because of their, and let me just show you, you know, I like to always have data to back up what I say. All right, looking at these two candles right here for the DIA. Today, it's got a big wick on the top and it's got a smaller body. All right, so when we go here, all right, let me take off what I drew last time about the shooting star candle. We want a big wick on top, right, and a smaller wick on the bottom. And if you look for a big wick on the bottom, a smaller wick on the chart, it could potentially, if you're looking over here, inverted hammer is what you were calling it, correct? Yeah, all right. So for that, what do we have here? We've got a downtrend. The downtrend stops, okay? And then it's reversing from that. So it would be a bullish sign. If we come back over here, and I got to clean up some of these highlighters here real quick. Just hang with me for a second. Oh, look at those candles. We're not coming out of a downtrend is what I would say. I would say that with this, yes, the candle independently by itself, you could say potentially a shooting star, potentially inverted hammer like you have there. But when you take into account what's been happening to the previous candles, the previous candle before today, big wick on the bottom, hardly any candle whatsoever. And then the prior day before that, it was a big rally. But if you look at the, and let me get my highlighter back out here. We've basically, from where that candle, that's not what I wanted. Anyways, 3 candles ago. Yes, a huge gap up in the morning, but it from where it opened to where we peaked, really we've gone nothing. We've gone nowhere. Nothing's really happened here. Okay? All right, so let's go back and look at the candles. And where do we see a big candle, a little candle right here? This is what you'd call a doji candle, okay? Notice how the previous day's candle, there's hardly any body whatsoever to the candle. And that's why when we were talking about this, I said these candles, they're neutral. They don't really mean anything, okay? All right, actually, I shouldn't have put the highlighter on there. I should have cleaned it up so you could see it too. Today's candle, yeah, there's a body, a big wick on top. The previous day, a very little body, a bigger wick on the bottom, a tiny, tiny wick on the top. So again, going back to the candlestick patterns here, it looks more like a doji to me than anything else, okay? Which is, to me, just neutral. Versus potentially being bullish coming in this downtrend here. As a matter of fact, let me just clean this up here. So my drawing isn't all on it. But for the inverted hammer, okay, You're going from going down, a downtrend. You have that inverted hammer, and that's a reversal pattern where then you start going back up. We haven't really been in a downtrend. We've basically been moving sideways, going nowhere. That's why I feel more comfortable with saying that it is a doji type candle than an inverted hammer candle. I will say, whatever the candles look like, it's okay to have your opinion. All right? Totally fine. If you're leaning more towards, you're thinking it's a hammer candle, there's nothing wrong with that. You know, that's completely fine. We're all here. I'm here to share ideas. Hopefully some of the ideas you haven't heard before and you can pick them up and put them into your own practice. So it's okay. But I am leaning more towards it's a neutral, means nothing candle here for the DIA. But I do see that there is strong support right above it. I mean, my apologies. Resistance. There is strong resistance right above it. And I would be looking to start shorting instead of thinking about going long in this situation here. Okay. Now, it is always possible, all right, that the PPI data tomorrow, it could be awesome. And it could cause this market to take off. All right. But we do have to be careful about these key levels that the markets are at. All right. The last time we were at key levels for the DIA was right before FOMC. It acted as resistance. The stock dropped and then it started to rally again. So that's always a potential too. We get to a resistance point. We get a pullback, a cool off from it. Then we get some good news and bam, we can break above it. So we can't judge what we should do off of any one thing. We need to have multiple points telling us that, hey, it's not looking so good for this to continue going up, or it's not looking so good for this to continue going down, or what you may have. All right. So just keep that in mind as you're trading or investing, which we're a little more focused on the trading at this particular moment in time, just because of the overall market. But we'll get back into investing as we get to that moment in time in the market where that makes more sense too. So we've got both. Okay, I think I've gone over most of the chart aspects of this. So I do have a couple notes that I want to talk about. Number one, let's go look at oil real quick. U.S. oil, because it's at a very key point itself. Okay, U.S. oil. That's the ticker symbol to use if you're in TradingView. There is a link in the description if you want to sign up for TradingView. It doesn't cost anything. It's completely free. All right, oil here. Oil continues to be a difficult trade. Why? In the long-term structure for oil, it's bullish. But it continues to be a tough trade because of the geopolitical concerns around the world. Today, oil had a sharp decline, back down to test its $85 a barrel level, which has been an important level. The potential for an ascending triangle, you can see it with the red resistance line and the blue ascending trend line. That is an ascending triangle. It is typically a bullish pattern. But what do we have right here? Well, oil is now, because it fell so far today, it is sitting right on that line. So we would need to see oil bounce tomorrow for this pattern to hold and for this to remain bullish. But a breakdown below this trend line would be seen as a bearish move for oil. So it's in a very particular place here where it could very well bounce. And I think the odds are probably a little bit more in favor of a bounce than a potential breakdown at this, but you never know. Headlines can change it quickly. All right. To sum up today's action, the action today is hardly encouraging for bulls, I think. The simple belief that the stock market moved too far, too fast last week, and that economic and earnings prospects continue to deteriorate, and Fed officials continue to talk tough about inflation still being too high, are all headwinds for this market. Now, the Fed speak, here's two kind of conflicting, but not really. It's not unanimous like it was at the FOMC meeting. We had Fed Governor Waller, who is an FOMC voter for 2022. Now, Waller said that we still have a ways to go before stopping inflation, or stopping interest rate hikes. Okay. And then we had the Fed Vice Chair, Brainerd, who said that the Fed may soon think about it being appropriate to slow the pace of rate hikes. So you have Waller saying we still have a ways to go before stopping interest rate hikes. And then you have the Fed's Vice Chair, Brainerd, who said it may be soon appropriate to slow the pace of rate hikes. A little bit conflicting. So it'll be interesting to see what other Fed speak comes out this week and how the market reacts to it. But this unity, it could be taken as another signal about a potential for a hard economic landing in 2023. So be cautious. Okay, let's talk about the dollar just real quick, and then we'll wrap this up. The dollar fell hard as the market rallied hard, right? Well, for me to completely give up with the dollar, it would have to get down to 105. All right. That's going to be my line in the sand right there. Now, the 200-day moving average is coming up like this. Okay. So it is possible that if the market does find a way to rally off of good news, that the dollar could come down, and maybe the 200-day moving average is in that 105 space where support is, and that acts as a big support for the dollar. Okay. So we do have to be careful with the data dump tomorrow for the PPI. If it shows inflation has come down significantly, it could rally, leading the dollar to come down to this point. This would be, I think, a very difficult place for the dollar to be in. Because if it breaks down here, then it's going to start losing a lot more, which means the market should start gaining a lot more, or the inverse correlation between the dollar and equities will be broken. Okay? Right now, it's still intact. So we'll have to see how it continues to handle. And if well, let me fix this chart real quick. I just want to show you real quick as we bring this chart together. You can see here all of 2022, the dollar has not come down to that 200-day moving average. Okay. All right. And 2022 began right about here on this chart. So we would have to go all the way back to the, I guess the dollar finally broke above the 200-day moving average back in June of 2021. And it's been making its move ever since. So coming back down to it, that'll be a significant area. And it looks like if the dollar continues to fall and that 200-day will continue to move up, it's going to get to that 105 area. And that's going to be an area of support, I think, for the dollar. But we'll have to watch and see how it will end up if it does get to that point. Okay, let's throw this one up here. And if you do have any questions, go ahead and get them in now. I'm just going to mention about tomorrow, and then I will be good for my notes today. So we do have some earnings tomorrow. Retail will be a big theme this week. We've got Walmart, Home Depot, Sea Limited, Krispy Kreme, all reporting before the market opens. And then we will also get the October PPI, okay? Producer Price Index. The expectation is a 0.5%, 0.5%. The prior reading was 0.4%. And then core PPI. The expectation is 0.4%. The prior reading was 0.1%. So we're not looking for, or analysts who put their expectations forth are not looking for giant gains here. We're going from 0.4% to potentially 0.5% for PPI and 0.3% to 0.4% for the core PPI. And then the other thing of note that we get tomorrow is the November Empire State Manufacturing Survey. Expectation is a -5. Prior reading was a -1.9. All right, to your question, can you explain and analyze all downgrade on red days and all upgrade as soon as they see green? Honestly, I don't know. I don't know why analysts do what they do. A lot of what quote unquote analysts do is follow a company, analyst. Am I not reading that right? Can you explain why analysts all downgrade on red days and all upgrade as soon as they see green? Well, I think when we're dealing with earnings, okay, when an earnings report comes out, the market is going to judge first how the stock is going to react. All right. Obviously, you beat EPS, you beat revenue expectations, which are set by analysts, and they're also set by the company itself for the most part. So once earnings come out, good or bad, the market reacts. Then typically the following day, you have a whole bunch of analysts who look at that earnings report and their analysis of that earnings report, it's going to follow what the market has already said they believe. Okay, so if you have an analyst at Morgan Stanley and the prior day after the closing bell, you have a company come out, they report earnings weren't so good. Then you have a analyst at Morgan Stanley who comes out with a downgrade the very next day because of what they saw in earnings. Maybe they put a specific reason. Maybe they copy and paste something that the company said. Supply chains are still being a problem for us. You know, it's being supply chain problems persist. And that's what they put in their little note that they send out. Supply chain problems persist. So we're downgrading this company. Or sometimes you have analysts who actually do the work, track these companies or sectors, and they actually call around to competitors and so forth and call the company and trying to get information from them. So they can come out with their own upgrade or downgrade. I'm not trying to be skittish on this question here. I'm trying to pull up an actual upgrade or downgrade here for you to use as an example. But for the most part, most of the upgrades and downgrades, they come around earnings, most of them. And then you have other upgrades, downgrades, they're sprinkled in, but there's usually a news piece about the company for why, for why, losing my words. Typically, there's a news piece that comes out about a company that you can trace the analyst upgrade or downgrade to that specific news piece. Okay. So most analysts, they're just doing what we're doing. They're reading earnings reports. They're reading news articles about that company. And then they're just putting themselves out as the authority, saying that, yep, they didn't do good on their earnings report. Well, we know that. We looked at the earnings report. We know they didn't do good. That's all that's happening. That's all that's happening. Now, there are some that actually do a fairly decent job tracking the industry and so forth. I mean, if you've seen, I know Kathy Wood gets ragged on a lot, but her analysts, I believe Kathy Wood has a couple videos out on her channel where she's talked about this before, or maybe they've interviewed somebody like this before. But their analysts will do actual research on the industry or the technology before putting notes out to their customers. But they're not typically known for having analysts that put notes out, like Morgan Stanley or Goldman Sachs or somebody like that. Yeah, all had downgrades. Yeah, all semis, sorry, all had downgrades a few weeks ago. All of a sudden, they're all being upgraded at once. Typically, it's a news event. Like a few months ago, when the United States said that they're putting restrictions on the types of chips that can be sold to China. A lot of downgrades then. So yeah, it's typically, it can be traced back to a news source, something that has been said about the company, or an earnings report, or even a press release from the company itself stating XYZ. That's typically where all of your upgrades and downgrades from analysts come from. Earnings, news reports, and press releases. Okay. And a lot of times the upgrade, downgrade will have copy and paste something about the earnings, something about the news report, or something from the press release that goes into the upgrade, downgrade for their quote reason why they are upgrading or downgrading. Setting a price, I have no idea, honestly. It could be as simple as they look at the chart, they find areas where, yeah, I don't know, they do some type of technical analysis. I honestly don't know the answer to that question of how they come up with their price, unless they're actually doing some kind of research and then comparing it to competitors and where they were at this stage of the game, or where they were within the S curve of making progress. So there's a lot to consider. So I don't know exactly how they come up with the number for the company that they put out. I'll leave it at that. Thank you for the question. I haven't had to think about that in a while for why something does what it does. I like those questions. I like those questions a lot. Okay. Any other questions, or we gonna wrap this one up today? I can't believe we've been going for nearly an hour and a half. That just seems crazy to me that we've been going that long. All right, I'll give you a moment to put in your question. Let me go over here to Bitcoin for a minute, because we did talk about this on Friday. And then I don't know if you guys checked into the public portion of our Discord or not, but we talked about how it didn't go anywhere. Now all of a sudden it has. So we'll open this one up. Time does go by fast. Yeah, exactly. When you're having fun, time goes by even quicker. So hopefully that means you're having some fun learning with me here. Or at least I hope you're learning something. Oh, come on. I didn't want that. Okay, anyways, we had a symmetrical triangle on Bitcoin on Friday. It ended up just moving sideways. It didn't really break down or break up from that symmetrical triangle from Friday. And the chart just seems to be stalling right here. All right, I guess it's done for today. Anyways, Bitcoin's dropped again. I do think that Bitcoin can hold, and I really wanted to show you the trend line here too. But I guess the chart's just been through too much and it's not going to work. Okay. Maybe we can get something going now. There we go. Finally. Okay, it just needed a little bit to go here. And it's still taking too long because it hasn't loaded any of the numbers up here yet. Okay. Anyways, I thought it still had the trend line and stuff on here. I guess not. Okay. One thing to point out, this bottom for Bitcoin over here, let me see what this was just real quick. 17,500. 17,500. And then, oh, there goes the chart. Okay, well, we'll wrap it up here. Sorry the chart pooped out on us. We'll pick it up tomorrow. Be back here after the market has closed to talk about what happened, why it happened, and what to expect going forward. Do be careful tomorrow morning with the PPI report. Obviously, it can move the market. The Fed is also going to want to cause the market to be knocked off this rally pedestal that it's on and bring it back down to earth. So watch for that as well. Okay, so I finally have the line back on the chart, the trend line. Even though it broke down, it still did not break out of this trend line. And we were looking at the 1 hour chart. I don't know if it's going to load or not. Oh, you are absolutely welcome. Absolutely welcome. Oh, well, I'll leave the chart alone. It's just taken too long to get to where I want it to. Even though it's almost there. All right. Well, if you could do me a favor, click that like button, share this video with a friend, and we'll talk about Bitcoin more tomorrow. It really hasn't gone anywhere. It did have a little breakdown, but it rallied right back up, which is a good thing, I guess, if you're into Bitcoin and Ethereum. I'm still into Bitcoin and Ethereum. I am not and have not been for a while into the other altcoins. I don't like them. I stay away from them. So that's that. Anyways, enough rambling on here. I'll see you tomorrow after the market has closed. Have a good day. If you do like this, though, consider clicking the first link in the description. Numerous benefits there for you that you can take action on yourself. So consider checking that out. And that's it, ladies and gentlemen. Thank you for spending your time with me. I greatly appreciate it. And I'll see you in the next video. Take care.